The money in your bank account doesn't really exist. That might sound like a riddle, a metaphor, or maybe even conspiracy talk, but it isn't. It's a simple, verifiable truth about how our financial system works. If every customer walked into their bank tomorrow morning and demanded the cash shown on their balance, the entire system, not just your bank, not just your country, would collapse before noon. The vaults would empty, the lines would grow, and panic would echo across every major city on Earth. Because the truth is, the money isn't there, and that isn't an accident. It's the design, a system so cleverly built that most people live their entire lives inside it without ever noticing the illusion that props it up. A trick so old, so invisible, that it's become the foundation of our modern world. That trick is called fractional banking. It is the quiet engine that powers global debt, inflation, and the illusion of prosperity. Once you understand it, you begin to see that our money, the lifeblood of civilization, is not wealth at all. It's a promise that can never truly be kept. To understand where this illusion began, we must step back in time, long before our world ran on digits and a glowing app. In medieval Europe, wealth was weight. Gold and silver were money, tangible and heavy. The wealthy carried their fortune in chests, coins, and jewels, but traveling with bags of gold invited danger, thieves, pirates, and kings who taxed on a whim. So people began to deposit their treasure with goldsmiths, craftsmen who had secure vaults for their trade. In exchange, the goldsmith issued a receipt, a simple handwritten note promising that the bearer could return at any time to reclaim their gold. And then, something extraordinary happened. People realized that these receipts were just as good as the gold itself. Instead of lugging metal, they could simply trade the paper. The note became a symbol of value, lighter, faster, and easier to use. But this convenience hid a revelation. The goldsmiths began to notice a pattern. Hardly anyone came to collect their gold at the same time. If they had 100 clients, maybe 2 would withdraw in a week. The rest trusted their receipts. And here, history bent. Because the goldsmiths made a quiet discovery, they could issue more receipts than the gold they held. If their vault contained 1,000 coins, they could lend out 2,000 in paper promises. Those extra receipts could be loaned at interest, creating profit from gold that didn't exist. As long as everyone didn't demand their coins simultaneously, the illusion held. And just like that, money was born from nothing. What began as a clever side business became a revolution. Once the public accepted paper claims as good as gold, money creation was no longer limited by reality. Banks grew from this practice, institutions built on the same sleight of hand. By the 17th century, even governments saw the potential. In 1694, the British Crown, buried in debt from endless wars, struck a deal. The newly formed Bank of England would lend the government more money than it actually possessed. In exchange for perpetual interest payments, it was genius. The bank profited from money it never had, while the government gained endless credit to fund empire and war. The debt would be repaid, not by treasure or conquest, but by the taxes of ordinary Englishmen. Sound familiar? It should. The very same mechanism sustains governments today. They borrow what doesn't exist, and we, the public, repay it with interest for generations. When the idea crossed the Atlantic, it found fertile ground. Early American banks issued banknotes redeemable in gold, but they too discovered that printing more notes than reserves meant exponential profits, until the panic came. Each time crowds of depositors lined up, demanding their gold, the illusion shattered. The money simply wasn't there. Banks failed by the hundreds, lives were ruined overnight, and trust evaporated. But instead of ending the system, governments doubled down. They built central banks, institutions designed to maintain confidence in the illusion. The message to the public was simple. Even if the money doesn't exist, we'll make sure you keep believing it does. Fast forward to today. You walk into a bank and deposit $100. You assume that $100 sits in a secure vault, waiting for you. It doesn't. Under traditional rules, the bank kept maybe 10%, $10, and loaned the rest out. that $90 might be borrowed by someone else, then redeposited, then loaned again. By the end of this invisible chain, your $100 has multiplied into nearly $1,000 circulating through the economy, but only the first $10 actually exist as cash. The rest is debt, born from promises to repay. Every new dollar that enters the system is someone's obligation. It must be repaid with interest, which means there will always be more debt than money. Now here's the twist. Since 2020, even that small reserve requirement, the 10% safety buffer, has been abolished in the United States. Banks are now required to hold zero reserves. So if they don't need your deposits to lend, what limits them? The leash today isn't cash, it's regulation. Specifically, international rules from Basel, Switzerland, written not by Congress or Parliament, but by unelected technocrats at the Bank for International Settlements, the central bank of central banks. Under these Basel rules, banks must hold a certain amount of equity capital to absorb potential losses. The riskier the loans, the more capital they must retain. But the key shift is this. Banks no longer lend from deposits. They create money through loans. When you take a mortgage, the bank doesn't hand you someone else's savings. It simply types new money into existence. Your debt becomes its asset. That digital entry becomes part of the money supply, backed not by gold or cash, but by your promise to pay. Today, over 90% of all money in circulation is not government-issued cash. It is bank-created money, born from loans, built entirely on debt. This system guarantees three outcomes. First, inflation. As banks multiply the same dollars into endless chains of credit, the value of each dollar declines. Prices rise not just because of demand, but because the currency itself is diluted. Second, perpetual debt. Because every dollar is created through borrowing, there is always more debt in existence than there is money to repay it. Someone must always default or borrow again just to keep the system running. Third, concentration of power. Banks earn interest on money that never existed. Governments use this system to fund wars, welfare, and bailouts without visibly raising taxes. And those who own assets, real estate, stocks, commodities, grow wealthier as inflation drives up prices, while ordinary workers lose purchasing power. It is the perfect machine, efficient, elegant, and cruel. When this machine stumbles, the illusion fractures. The Great Depression of 1929 began with banks lending recklessly beyond their reserves. When confidence broke, depositors rushed to withdraw what wasn't there, and thousands of banks died overnight. In 2008, history repeated. This time, the illusion hid inside mortgage-backed securities, debt upon debt, promises upon promises, until the system buckled. And once again, governments stepped in, printing trillions to patch the illusion and keep the game alive, because without it, the modern economy cannot function. Across the world, the pattern holds. In the US, reserve requirements are gone. In Europe, the UK, Canada, and Australia, they're symbolic. Basel now governs the leash. Meanwhile, in countries like China, India, and Brazil, reserve ratios remain higher. But even there, the Basel framework defines risk and lending capacity. It doesn't matter where you live. The rules of money creation no longer come from your nation's parliament, but from a meeting room in Basel, Switzerland. Here's the truth no one likes to hear. The system depends on your debt. If every household and business paid off their loans tomorrow, the money supply would collapse overnight. The economy would freeze. Banks would have nothing to lend. You are both the fuel and the collateral of this system. Your belief sustains it. Because in the end, fractional banking isn't just a financial trick, it's a psychological one. It depends on trust, confidence, and collective amnesia. As long as people believe the digits in their accounts represent real wealth, the illusion holds. History doesn't repeat, but it rhymes, from the goldsmiths of medieval Europe to the bank panics of the 1800s, to the housing crash of 2008. Each crisis reveals the same pattern, promises multiplied beyond reality, belief stretched until it snaps. The lesson is not paranoia, but awareness. Money is not wealth. Real wealth is land, resources, skills, and knowledge, things that endure when paper promises collapse. Debt is not neutral. It's the bloodstream of a system designed to favor lenders, governments, and asset owners. Inflation is not a mistake. It is engineered into the design. The silent tax that ensures you must run faster just to stay still. If your money is born as someone else's debt, then your freedom begins when you learn to step outside that machine. If this gave you a new way to see money, hit subscribe. History has the answers, and the Money Archive will show you where to look.